Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
9 is what we have. That's absolutely in line with the poll that Mangalam was throwing up. Mangalam, we're still waiting by. I'm going to look at the press release if we get that. But why don't you quickly run us through your estimates in the meantime? We just have the profit figure. That seems to be absolutely fine.
Absolutely.
Right?
I'm trying to get the press release as well. I think it has opened on my computer. 1529 on the bottom line looks absolutely in line with what we were expecting. Just trying to get in a couple of more details as well. 9622 as far as the total income is concerned, that looks like it's a little bit below our expectations. 9487, yeah, we were expecting a number of close to 9700 crores on the top line for Hindustan Unilever. So 9487 crore in terms of the operational revenue for Hindustan Unilever for this quarter would mean a growth of close to around 11.2%. That's a good 200 basis points lower than what we were expecting. And just trying to get in a view as far as the volume growth is concerned, any details that you have out there, Surbhi? But as of now, it looks like 11.5% in terms of revenue growth, 11.2% if you must, is a little bit below the expectations, though the net profit is absolutely in line with our expectations. Trying to get in some more details as well as we speak. Well, advertisements, they've increased year on year, no problems out there. 1153 crores, that compares to about 905 crores. Well, no further details that I have as of now, apart from the numbers that are flashing for us on the screen.
So I can only give you some of the segmental numbers that I have at the moment. I think you've already read out several.
All right, our team tells us that it's the 12% volume growth. So the volume growth looks absolutely in line with what we were working with. We were working with a range of about 11% to 12%. That means that the margins would have expanded a little more than what the street was working with. The EBITDA that I would just like our ticker team to perhaps flash the EBITDA. We were working with a number of close to around 2200 crores. While I calculate the EBITDA as well, we have Prakash Diwan joining in now. 12% volume growth, Prakash, pretty much in line with what the street was expecting. Revenue growth of 11.2%, a tad bit below expectations, but nothing really to complain about out there as well, because the net profit looks like it is pretty much in line with expectations. The stock is at a record high, doesn't trade at cheap valuations. Do you think this result would be a trigger for the stock to consolidate in the near term?
No, I think, Mangalam, what's important is that they've not compromised on margin growth, in spite of keeping volumes on the higher side. So, so we've kind of now getting used to that 10 to 12% volume growth range. And then if they continue with that, and of course, post-monsoon, things could look up. The MSP is expected to do both things, increase their prices as input side, as well as probably leave more spending with people, with consumers. But my sense is this current quarter is going to be more challenging. The quarter gone by is really not something which was expected to create any, any troubled air pockets for them. So that way, it's a decent enough consolidation. If you ask me, there's not much room for consolidation also, because the stock is attractive. It's one of the few heavyweights in the Nifty which has not, done in the recent past. It's, of course, reached 1700 plus, which is a good level from where we've historically seen it. But the multiples don't, give you that headroom. So it'll probably be range bound, but not much of selling or profit booking that could come because of these numbers.
I just want to highlight some lines on the commentary, whatever little color we can pick up from the release. So the cost of goods sold was lower on account of the mix, judicious pricing and a strong savings program. Advertising and promotions have been stepped up to support innovations and activations and also respond to a competitive scenario in the marketplace. Then they're highlighting some risks on the margin front, and that's pretty obvious. But just to state this, in the near term, we see gradual improvement in demand and our focus will continue to be on innovations. Crude volatility and currency-led inflation are the key risks going ahead, and we will continue to manage our business dynamically. But Mangalam, having said this, 12% volume growth is not something to kind of scoff at all, I guess. And as Prakash is also pointing out, the fact that they've managed to hold margins at least for now. So, all in all, you would give a thumbs up to these numbers?
Absolutely. You would give, I don't know whether you give a thumbs up or thumbs down to these numbers. You would call it as pretty much in line with what the street was expecting, given the sort of rally that the stock has shown as well. So 12% volume growth, yes, it was absolutely in line with expectations. The margins have come in a little higher than expectations because the EBITDA, that one's come in at 2251 crores. We were working with a number of 2200 crores. So 50 crore beat on the EBITDA, which has meant that the net profit is in line with expectations. So to get that and more, perhaps we are joined with Abneesh Roy as well. Abneesh of Edelweiss joins in. Abneesh, 11%, 11%, 12% in the last 3 quarters in terms of volumes. Next quarter too is slightly soft in terms of a base. So what kind of numbers are you factoring in for the second half of this year, and more importantly the first half of FY20, because then the base won't be as low, and in the kind of valuations the stock is trading at, what would your call be?
No, we continue to remain positive. So if you see third quarter of 11% plus volume growth and gross margin expansion in spite of inflationary condition does show the pricing power. And in spite of high ad spend, the EBITDA growth of 20% is a good number.
Sure. Abneesh, sorry to interrupt over there, but the management's actually speaking. So let's connect after we hear him.
And refreshment divisions to increase agility and better serve consumers. Accordingly, the company will report its results in the following 3 operating segments. Home care, which remains unchanged. Personal care is now designated and better serve consumers. Accordingly, the company will report its results in the following 3 operating segments. Home care, which remains unchanged. Personal care is now designated as beauty and personal care. And foods and refreshments has now been integrated, and this includes food solutions. Now focusing on performance. From a market point of view, we are seeing a gradual improvement in demand. In this context, we have delivered another quarter of strong volume-led growth. Our reported revenue growth was 3%. Our comparable domestic consumer growth, which is like for like, after eliminating the accounting impact of GST, grew at 16% with underlying volume growth of 12%. Our comparable EBITDA margins expanded by 100 basis points, and our EBITDA at 2251 crores was up 21%. Our profit after tax but before exceptional items, PAT BEI, stood at 1567 crores, up 21%, and our net profit at 1529 crores grew by 19%. On the cost side, our cost of goods sold was lower on account of benefit of mix, judicious pricing, and savings. We continue to invest behind our brands. Our increase in A&P spend was driven by investments in innovations, activations, and competitive actions in the marketplace. Now let me spend a little bit of time talking about our divisional performance. All our 3 divisions have during the quarter delivered double-digit volume growths. Home care, we have delivered a robust performance with comparable growth of 20%. In laundry, all our key brands grew in double digits with good growth momentum. In household care, double-digit growth was led by strong performance in Vim. Domex liquids was relaunched in South India, and Domex powders extended to new geographies. In beauty and personal care, growth was broad-based and across both personal products and personal wash. In skincare, Fair & Lovely and Pond's registered strong growth. Double-digit growth in hair was led by the premium portfolio, and Indulekha delivered another quarter of strong performance. Growth momentum was sustained in color cosmetics with the continued and successful rollout of various innovations. The Lakme 9 to 5 natural range of makeup and skincare products infused with aloe vera was launched during the quarter. Deodorants delivered an impressive growth with Axe Ticket gaining traction. Personal wash grew well with a high growth trajectory being maintained by Dove and Pears. Moving on, foods and refreshments witnessed a strong growth, ice creams and frozen desserts. In beverages, tea delivered broad-based double-digit growth across key brands. In coffee, Brew Kannadigara was launched in select geographies to cater to local taste preferences. Ice creams and frozen desserts grew in double digits during the season on the back of innovations and geography expansions. Foods registered double-digit growth led by Kisan and Nor. As you're aware, we also launched the Lever Ayush breakfast range in Tamil Nadu. From drivers of growth, I think it continues to be relentless focus on innovation, impactful activation, and sharper in-market execution. We continue to sustain investments in market developments and in emerging categories. Looking ahead, we expect gradual improvement in demand. Crude volatility and currency inflation are key watch-outs. Also, in the near term, a step up in competitive intensity is anticipated. Our focus remains on volume-driven growth and consistent improvement in operating margins. Our strategy, therefore, remains unchanged: consistent, competitive, profitable, and responsible growth. Thank you.
This is Priya from CNBC. I wanted to understand with regards to rural growth. The last time we spoke, you said that you were a little bit cautious about rural growth. And you said that in the first quarter, when we really know whether the rural growth has bounced back. So is it back to historical levels? Is it growing 2 times or twice the rate at which urban has been growing? And secondly, on the input costs, I want to understand what is the kind of trajectory that we can see? Because you said that it's a space that you will continue to watch out.
Yeah, but Priya, let me be very consistent. I had said last quarter and even a quarter before that we should wait for a few quarters to see if there is an underlying trend which is emerging. Yeah. So we aren't yet at a stage because, the base, this was the pre-GST quarter last year. So it would be wrong for us to look at just the headline numbers and come to a conclusion. The quarter has been very decent for us with 16% top line, 12% underlying volume growth and 100 bips improvement in margins. So there is very clear we are satisfied with the performance. It is broad-based. If I look at it from the market perspective, certainly rural, which went through a pretty lean period in 2016, 2017 was a year of massive disruption in the market, so I wouldn't want to pick up 2017. But definitely rural has started growing, and it now from all indicators, it is growing at a rate faster than urban. But the markets are still, if you look at offtake, not the growth numbers, the markets are growing in the vicinity of 6.5%, and the volumes are growing at 5.5% for the markets in general. They are better than the 3% kind of volume growth that we saw in 16. Yeah, but they have certainly improved, and we are very hopeful that they will continue to improve. But a definitive trend, let it normalize, the base become normalized, then we will start seeing.
So on the input cost, if you really see in the quarter, I think there are two elements playing out here. First, when you see crude and crude related, we have seen a significant increase. We've also seen depreciation coming from the currency. However, when you start to look at some of our veg oil portfolio, which is really not cleansing, we've also seen costs being low when you compare year on year. So therefore, when you look at the totality of the mix, in the quarter in question, we may not have seen the kind of inflation. However, when you look into the future, and I think that's something is a key watch out, as we said. Now on the crude side, we see a lot more volatility, also driven by some of the international factors. Currency continues to be under pressure. And we also expect that some of the flow through of the crude related will now start to come in. So it's an area of clear watch out, and we'll have to see how to dynamically manage our business.
Can we expect some kind of price increases going forward?
So I think here we have always been consistent. Look, there are many levers to run a business and how to maintain your profitability. Judicious pricing is one of them. Even in the quarter in question, we have taken some price increases without losing market competitiveness. So clearly we will look at all levers, and where required, when required, we will look at judicious pricing.
One compulsory commentary. We've completed 1 year of GST. Just want to understand, July 1st is when we completed. So just want to understand the commentary. Has the industry completely settled down from the impact of implementation last year? Or are we still seeing some kind of residual issues in some kind of, probably in trade pipeline or elsewhere?
Would you like to?
So I think if you see from an implementation execution point of view, I think it's all now well settled in. Yeah. So I think we've gone through GST 2.0. We have seen the e-way bill implementation. So at least from an operational point of view, I think it's fairly stable. And I think we've talked about it either when you see from a trade pipelines point of view, there is also stability. So all in all, I don't think from an operational point of view, there are any issues. And actually now it's business as usual. Having said that, I think there are still elements. I still think there is working capital which we need to unlock. As we have gone through filing of our various returns and looking at some of the refunds on exports and looking at some of our fiscal units, there is money which we still need to realize which is stuck up in working capital. But day-to-day operations, I think it's business as usual.
I wanted to talk about pricing once again. Do you think, over the last year we've seen pricing go through a significant change, and now do you think pricing power is back with companies? Do you think that companies are in a better position to sort of take the lead and sort of increase prices going ahead?
I wouldn't want to comment on the industry at large. I think what I'll do is comment on Hindustan Unilever. First is, last year when the GST rates went down, we took the prices down of our products and passed the benefit to the consumers. So the good bit is, even when there is some inflation, the price of our products would still be cushioned by the reduction that took place after GST. Yeah. Now, price volatility is not something which we are seeing this year. It has always been there. Whether it is veg prices, whether it is crude prices, the prices go up and the prices go down. I think what is critical to remember is, as Hindustan Unilever, we have the necessary agility to respond to the volatile prices. Yeah, so we are always judicious, as Srini mentioned, in terms of price increase, and we will always keep price value equation when it comes to looking at it from the lens of consumers.
The price of the stock went up ahead of earnings, and investors are becoming more conscious and turning attention towards how earnings growth are justifying valuations. How would you say, or for how long would you say that HUL's dream run on the bourse is going to last?
See, I would not like to comment on the stock price, but I would definitely want to comment on our financials. And if you look at it over the last 7-8 years, we have consistently improved our margins. I think 26 out of 27 quarters, we have improved our margins. Even during the toughest period, we have grown our business. So I'm very pleased with how we have navigated turbulence and how we are reshaping our business for the future.
Will the impact of
All right, so that was the management of Hindustan Unilever commenting on what will go down as an inline set of numbers for the first quarter of FY19. The key highlights from the management commentary. The first one, they are a little worried as far as input costs are concerned and also the currency. So that is something we'll be watching out for. In terms of rural recovery, they have seen an improvement in rural demand from the earlier 3.5% in terms of volume growth to about 5.5%. Can this be a trend, underlying trend? Perhaps the management would like to wait by for a few more quarters to make that assessment. As far as the numbers are concerned, the revenue was a tad bit below expectations, 16% comparable growth, volume growth absolutely in line with what we were working with. EBITDA a tad bit better if you must, which means that the net profit has been in line with expectations. Net profit would have been much better had there not been that exceptional of 59 crores. So the net profit perhaps would be better than expectations on account of improved operational performance. So